All right, welcome to Talk Tickers. Today we're digging into Alerus Financial, that's ticker ALRS, and their fourth quarter earnings were, well, they were a bit of a head-scratcher. They posted this huge loss, but the stock actually went up. So what's really going on here? Let's break it down.
So here's the mystery right up front. The official number, the GAAP loss, was a negative $1.27 a share. I mean, that's a big, ugly number. But the stock rallied more than 2%. How does that happen? It's all about what investors were looking at versus what the headline said. And that's exactly what we're going to unpack.
In this slide right here, it just lays it all out. On one hand, you have that GAAP loss of $1.27. But on the other, the adjusted earnings per share, a super strong 85 cents. Now that adjusted number is what you get when you pull out any weird one-time stuff to see how the actual business is doing. And you can bet that's what Wall Street was paying attention to. So the big question is, what was that big one-time event?
Okay, so let's talk about the big one-time hit. This wasn't a case of the business suddenly falling apart. No, far from it. This was a totally deliberate, strategic move by management. They called it a strategic reset, basically taking a short-term hit on purpose to set themselves up for a much better 2026.
So what in the world is a balance sheet repositioning? You could think of it like this. It's a big trade. They sell a bunch of their old, low-interest assets, which means they have to book a loss on them right now. But then they take all that cash and immediately buy new assets that pay a much higher interest rate. So yeah, it hurts for one quarter, but the idea is to seriously juice their earnings for every quarter after that.
And when I say they went big, I mean they went big. We're talking about $360 million worth of securities that they sold off. This wasn't just dipping a toe in the water. This was a massive overhaul of their investment portfolio.
But here's why they did it. This is the payoff. The stuff they sold was only kicking off a 1.7% yield. Pretty pathetic, right? But the new securities they bought? They're yielding 4.7%. That is a huge difference. It's like trading in your old clunker for a sports car. This is going to generate so much more income for them, and that's not a one-time thing. That's a boost they'll see every single quarter from here on out.
Now, a move like this isn't free. It came with a price tag, and that price was a $68.4 million pre-tax loss, all in one go. And that right there is the number that dragged the official earnings down to that negative $1.27. So, puzzle piece number one is solved. The loss wasn't a mistake, it was a strategy.
All right, so we've explained away the scary headline number. Now, let's get to the good stuff. Let's talk about the core engine of the bank, because this is what the market actually saw and what got everyone so excited.
So, if you ignore that one-time charge, ALRS didn't just beat Wall Street's expectations. They absolutely blew them out of the water. Analysts were expecting 57 cents. ALRS came in and posted 85 cents. I mean, that's a nearly 50% beat. You don't see that every day. It's a massive signal that the day-to-day business is incredibly strong.
And this wasn't just a one-trick pony. The strength was everywhere you looked. Their net interest margin, that's a super important metric for bank profits, jumped up to 3.69%. The returns they're getting on their assets and their equity were fantastic. Look at that return on tangible common equity, over 21%. And most importantly, the actual tangible value of the company per share kept growing. That's how you build real wealth for shareholders.
You know, one of the things that makes Alerus really interesting is its revenue mix. Check this out. 41% of their money comes from fees, things like retirement services and wealth management. For a bank, that is a huge number. It's like 3 times the average for their peers. And what that does is it gives them this really stable, high-margin income stream that isn't totally dependent on what interest rates are doing. It's a huge advantage.
Okay, so management basically said, the reset is done. Now they're moving on to what they call the accelerate phase. And their guidance for the next year? Well, it shows they're pretty darn confident that the pain they just took is about to pay off in a big way.
And here's what that outlook looks like. They're telling us to expect loan and revenue growth in the mid-single digits. But, and this is key, they're going to hold expense growth down in the low single digits. That gap, that's what we call positive operating leverage. It's the holy grail, really, because it means your profits grow faster than your sales. On top of that, they expect that juicy net interest margin to stay strong, right in that 3.5 to 3.6% range.
So where do we go from here? What does all this mean for the next earnings call and for the stock price? All right, time for the next call, where we give you our take.
Here are the things you absolutely have to watch next quarter. First, that net interest margin.
We need to see it stick at these higher levels now that the new investments are fully in the mix. Second, loan growth. Is it good quality growth? Is it coming from them snagging top talent from other banks like they said? And finally, you got to watch deposits. The fight for deposits is fierce, and we need to see if their costs start creeping up. That's a risk for pretty much every bank out there right now.
So, for our first prediction, we think that net interest margin is going to push right up to the high end of their guidance. The full effect of that big trade they made is going to kick in, and we see them landing much closer to that 3.60% number.
And what about the stock price? We're not expecting a rocket ship, but we do see it steadily grinding higher. Look, the narrative has shifted. It's not about big strategic moves anymore. It's all about execution. If they can just keep delivering clean quarters on this new, higher earnings base they built, the market is going to reward that consistency, for sure.
So to wrap it all up, what's the final verdict? Honestly, management made a really smart move here. The reset was clever, it was bold, and it was great for shareholders long term. But, and there's always a but, the environment for banks is tough, especially that battle for deposits. That risk, the risk that they might stumble on the execution, is what's keeping us from getting super bullish right now.
And that leads us to our official rating. We're calling Alerus Financial a market perform. We think the stock will basically track along with its peers in the regional banking space. Now, could it do better? Absolutely. If they can nail their growth plan and handle the deposit competition, there's definitely upside here. But for now, we're staying neutral.
And as always, remember, this is not financial advice.